Hey, Steve Saretsky here. As always, this is the Canadian real estate market update with a particular focus on Vancouver. If you're getting sort of value or entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Questions, comments, put those below, and we'll banter back and forth. As always, this week we're sort of going to cover a couple things on the top of my head, some things that I'm reading, some certain data points, and we'll get into all that stuff and how that all factors in. But firstly, I want to touch on I think, which is a very important and critical tool that I always start with and has really been the focus of these videos, is after meeting with, really on a day-to-day basis, investors, real estate developers, land acquisition guys, institutional investors, PhD economists. It has come to a very obvious reality that 99% of people don't actually understand credit cycles and how they work and the impacts, how that impacts real estate markets. So first and foremost, I don't want to just pontificate and say, hear it from me. There's actually a free book out right now that if you want to learn on credit cycles, that I would highly recommend you check out, by free, from a billionaire with a B, Ray Dalio, who's ran one of the most successful hedge funds really to date. So he's basically put out like a 400-page free book on credit cycles, debt cycles, how to navigate them. Again, this guy has made billions of dollars. So, I mean, you can either take his advice or take it from an economist or real estate developer, etc. So I would encourage you don't have to read the full thing. I'm reading it right now. I mean, truthfully, you can read the first 20 pages and it'll probably summarize everything that you probably realistically need to know. But I'm about 100 pages into that now, and it really sort of reaffirms everything that I've sort of been talking about, which is that ultimately these credit cycles matter. So people get very focused on the micro of real estate. What are sales doing? What is prices doing this month? But real estate is heavily dependent on leverage, and with added leverage, you need more credit. So if credit is unavailable, as it is today, we see credit growth fall off and we see prices following suit. But basically how these things work in cycles is these ultimately impact prices, sales volumes, rents, employment wage growth, rental prices. They're all correlated. So we're seeing the news today, the BC government capping rent prices, developers talking about how it's going to create a supply shortage, etc. I'm going to get into all of that, but first I'm going to explain the credit cycle. And again, I highly encourage you to check out Dalio's book. So what happens is when you hammer interest rates down, you lower interest rates, you're basically encouraging people to borrow money because the ability to borrow that money becomes much cheaper. So what happens is banks start lending money and people start borrowing. And when you're able to borrow money, you essentially you're going to start spending more. You can start spending more because you're able to borrow more, and the cost to service those interest payments are lower. So as you're spending more, consumer spending goes up. That ultimately increases wage inflation. That increases wage growth. You're spending more into the economy then starts growing, your wages grow with it. As your wages are going up, you become a more credit-worthy borrower. So now the banks are more comfortable lending to you from a real estate perspective, right? Like, why not give you a loan when your wages are going up, the economy's growing, all of a sudden the asset prices are starting to increase. So it basically creates this positive feedback loop. It's a positive sort of credit cycle. Everything sort of flows into one, and as you have a growing economy, you have growing population now. So everyone is looking, saying, wow, as a hypothetical, Vancouver and BC, they're growing. Look at the wage growth, look at the run up in asset prices. So now you have people coming in, say from Alberta, that where their economy is kind of in the dumps. So people come here, and it's again self-fulfilling. You have to look at that from a foreign investment perspective. We had a lot of outflows from China coming into Vancouver. They're looking at it as again a sort of a stable economy starting to grow. Asset prices are starting to rise. So why not funnel money in there? So now you're adding in even more credit. Again, this is sort of that credit positive feedback loop. But at the end of the day, you can only continue to get into debt so much further. At the end of the day, you can only continue to grow on that. And at some point, the asset prices increase to a level where the return is simply not worth the price or the risk to pay. In other words, you can look at rental or cap yields basically being suppressed, and the numbers effectively don't make any sense. So then you have the reverse effect where all of a sudden interest rates start going up. You're not able to borrow as much. You're not able to spend as much. Asset prices start to decline because they're very interest rate sensitive. So now you're in the meantime, as the interest rates are going up, your debt service payments become more burdensome because the cost of the interest is going up. So now all of a sudden, your debt service payments are going up. The banks now see you as a less credit-worthy borrower, and so that ultimately, again, feeds on itself into lower asset prices. Obviously, lower asset prices reduces the wealth effect, where now all of a sudden you start spending a little bit less in the economy as your house prices start to drop. And then all of a sudden that starts to spur into wage growth, and then you basically enter into sort of at the top of the cycle, turning down into sort of a deflationary debt spiral where you're paying down debt, wages become suppressed, people start to leave the economy for other prospects into other economies that are maybe growing, so your population growth starts to slow down. And again, this is just self-fulfilling on the way down. So, when people say, look at Toronto, it's suddenly having this rebound and it's ready to tick back up. Well, it's really not. It hasn't really actually played out to its credit cycle yet, and neither has Vancouver. You have to start paying down these debts, and we're actually still really in the expansionary phase, but we're nearing the top of that expansionary phase and ready to head downwards. And those downwards spirals, as Dalio says in his paper, can sometimes take between 5 to 10 years, depending on how they manage that debt deflationary environment. But again, this isn't from me. This is from a guy that's literally made billions of dollars, and not just someone that wants to sit there and pontificate, but has used that framework to make a substantial amount of money. So again, that brings us into context of like, okay, so what are we seeing here in Vancouver? What kind of correlations can we have? I mean, again, people talk about Toronto, etc., but you're basically in the longest expansion in recent financial history. We're at 10 years of an expansionary upcycle. And so, you can't necessarily time it, but you kind of have to position yourself and say, okay, well, where are we in that cycle? Again, you can't time a top of a cycle or a bottom of a cycle, but you just have to ask yourself, well, where are we? Again, you're in the longest expansion in recent financial history, and now you're starting to see debt service ratios increase, interest payments increase, and asset prices starting to decline. So that's kind of where we're at. And then I'm looking at, okay, so leading indicators. One of the leading indicators is housing starts. So in Metro Vancouver, we actually have housing starts that have recently peaked out in March of 2018. So you have the housing starts peaking out and starting to roll over. They're down about 4% from their peak. Again, it's early to call, but it's hard to see anything that's going to reverse this. Again, based on my conversations with developers and people that are helping them with the purchase of the land, etc., is most of them aren't buying right now. So that basically tells you there's a lack of confidence, and when housing starts to roll over, and housing supply, construction starts to roll over, you have 10% of the BC economy employed in construction. So any sort of slowdown in that segment is going to be a massive drag on employment and wage growth. And that has, again, its feedback loop that we will have to go through at some point. So I think the housing starts are incredibly important to watch. I mean, as it stands today, we still have a record, I think 43,000 units under construction in Metro Vancouver. So they're going to work through those as they slow down their housing starts, but housing starts are generally a leading indicator of future economic growth. Basically, again, shows sort of the confidence in the economy from developers, and the development, construction, and real estate sectors are so big, particularly in BC, that any sort of slowdown in that is going to have a impact moving forward. But again, you know, we're looking at these cycles, and that sort of talks to population growth. Again, where are we today? Population growth is actually growing at its fastest pace since the 1980s in Canada, and this really comes with the credit boom that we've had in the last few years. Private debt to GDP has grown, I believe, 20% over the past 5 years, which is the fastest in the G20. So you've had those credit inflows, you've had that lending increase, you've had the asset price increase again, which attracts more people, wage growth, etc. So wage growth has been rampant, population growth has been rampant, and now you're starting to see some of the leading indicators starting to tick down, such as housing starts. So you know, these are things that we very much need to pay attention to. You know, with that being said, again, you can look at some examples. So it is inevitable, and each city and case is slightly different. That's not to say, you know, history doesn't, it's the old saying that history doesn't repeat, but it certainly rhymes. So we're looking for things that might change, and this is, again, why I put this video together, is people have this misconception that most of the people that I talk to, whether it's investors, developers, etc., that even economists, that, you know, wage growth is just going to continue unabated, as well as like the rent prices will continue increasing despite a real estate market that might fall. And I think a lot of people I speak to agree that it's going to decline and continue to decline, that the rent price will somehow be stable. But this is really a misnomer. So we look at areas in the U.S. housing boom, whether it's Phoenix, California, Miami, Las Vegas. We'll take Phoenix as an example. So their population growth was, in the boom years from 2003, I believe it was, to 2007, their population growth was growing at 3.7% annually. 3.7% annually. After the housing bust, because Phoenix was hit particularly hard, their population only grew by 0.5% from 2008 to 2011, I believe. So you had 3.7% growth annually in the housing boom, down to 0.5%. You also had rental vacancies increase. I believe it went from 6% to 13%. And then you had rent prices get slashed by about 15 to 20% in that area in Phoenix. So again, I mean, Vancouver is obviously different. We've never historically, over the last 15 some odd years, we haven't had a vacancy rate above 3%. So you know, there is that argument, but there's no question that if you look at the entire province of BC, whether you're in Kelowna, Victoria, Vancouver, Prince George, anywhere in BC, they're all suffering the exact same thing, which is they're all in a housing crisis. They all have vacancy rates sub 1%. They all have extremely tight labor, large run-ups in wage growth. You know, I was just up in Prince George looking at some properties up there, talking to contractors to say, hey, can someone actually come in and fix this house if I buy it, hypothetically? And they said, no, you know, all my contractors are too busy. Again, that's just like a red flag that you have. This is just essentially a province-wide boom that is ultimately fueled by the increase in credit and that credit cycle. So but we're starting to see all these markets simultaneously coming off. But the interesting thing that, again, when you tie this all in together, is people to assume or expect that wage growth is going to A, continue, B, population is going to continue to grow at the pace that it has been growing at, and C, that rent prices or vacancies are going to be like this forever. Because you keep hearing these supply side people, we need to build more housing, more housing, more housing. The developers are now saying that because the BC government recently cut annual rent growth for 2019, it was generally inflation plus 2%. So it would have been 4.5% in 2019. They just cut it and they capped it right at an inflation of 2.5%. So now the developers are saying, okay, we're going to cut off all our housing supply. We're not going to build purpose-built rentals. We're going to go to selling condos. They think that the rent controls being capped to 2.5% is what's going to discourage that, and that's why the housing supply has been shrinking because of the BC government. The housing supply is shrinking because you're at the end of a credit cycle. The developers know it; they can't make projects feasible today at current land prices. Banks are hesitant to lend, so it's becoming more difficult to get construction loans, etc. So this really has nothing to do with rent controls per se. It may discourage a couple developments, but ultimately housing starts we're going to turn down regardless of what any government did. As soon as credit starts ticking down and you reach that point, it's going to happen inevitably. And we're starting to see that in Ontario as well. Again, obviously they're blaming the government for over-regulation, large CAC development fees as the reason why, but it's simply not. This is just what happens in a real estate credit cycle. So anyways, I'm not going to ramble on too much about sort of why maybe people are wrong, but I just think that we've created this sort of complacency of a long-term bull market, that good time. People like to extrapolate things that are happening in the present into the future. But again, this is all cyclical, and that's been my framework from the start, and I've really stuck to that, besides having some sort of minor ups and downs, fluctuations of prices, etc. But we're seeing the credit growth slow to its slowest pace in 20 years, as well as debt service payments ticking to its highest in 10 years. And this is all signs of a credit cycle winding down. The Bank of Canada is expected to hike rates at the end of October, following the Federal Reserve in the U.S., which just hiked earlier this week. So that's where we're at today. Use that framework. I would again encourage you to go look out Ray Dalio's book. The guy's pedigree speaks for itself, and just kind of hope try to sort of educate people, even developers. I'm always just sort of looking out for people and see how I can help them, but ultimately most don't want to listen, and I think it's created this long bull market run up where you've created a concerning complacency bias or confirmation bias, basically rejecting other ideas and just going with extrapolating recent performance inevitably into the future. And so something we'll watch for. Hope that helped. Otherwise, see you next week.